What's up, Denver? Chris Lopez here, and today we're going to be walking through a fix and flip in Aurora, Colorado, but really focus on the financing aspect of it and how the numbers work and some different options flippers have out there. Now, walk us through the deal. I've got my friend Travis Sperr in the podcast studio. Good morning, Travis.
Hey, Chris. Thanks for having me here today.
So I think a lot of listeners know who you are, Travis, but that those don't. You've been an investor and hard money lender for a decade plus around town. Recently went over to a new firm, Renovo Financial, with some really cool lending products in like the private money space, from fix and flips to new construction to like long-term rental products as well. So you got experience and a wide variety of lending products. And we'll put a link in the show notes that kind of introduces you and your lending products with Renovo. But really want to focus on this fix and flip you did here, because you have lots of experience from doing yourself, and you've also done probably hundreds of loans of those over the years, maybe thousands.
Sure. Thousands, yeah.
Thousands. Okay, so you know this. So walk us through this deal, like the starting off point. What's the basics?
Yeah, so this deal is really straightforward and probably kind of fitting for the market today, in that we're not really seeing the medium fix and flips anymore. I guess what I mean by that is like
medium.
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 What I mean by that is like you have kind of light, like quick in, out, back on the market in a short period of time to kind of eliminate market exposure. And you have like really heavy, right? Like total rehab, finishing basements, maybe roof, windows, etc. It seems like those opportunities that were kind of in the middle are not as available as they once were. Like let's call it like the $40,000 to $60,000 rehab, just rough numbers. So this one kind of fits the lighter side. This was a newer house, Southeast Aurora, like probably less than 20 years old. The borrower got it under contract off market, and he was actually going to wholesale the deal, but his buyer fell out, and he still felt like it was a good opportunity, so he wanted to close on it. So we connected, needed to close quick. I think we closed it in like 6 business days or something like that, which is pretty quick, considering he had under contract for a while. So
he had to close quick because his buyer fell out.
Exactly.
A week before closing?
Exactly. And
what type was an assignment contract, double close?
I believe it was going to be an assignment.
Okay.
Yeah, that's right. No, let me take that back. It had to be double close because when he wasn't going to be able to close, then our borrower still had the contract. Yeah, okay. It was double close. And so he called us and we said, yeah, the timing will be tight, but let's get it done. So we use a BPO for valuation rather than an appraisal. So that gives us the ability to move pretty quickly and relatively inexpensive for the borrower for the valuation.
What's a BPO?
Broker price opinion, right? So you're using an agent who's using a similar to appraisal type of format to drive a value rather than going through the time and cost of hiring a certified or licensed appraiser.
Because BPO is what, $150, $200?
A little more than that. I mean,
I haven't done one for years.
Yeah, so closer to $400, but the benefit is that we get them back really quickly. So, rather than spending the absolute least and waiting 7 to 10 days, we spend a little more and know that we get the value back really fast.
Okay.
Yep. So we get the deal. This borrower's done a lot of deals over his career. He's been in real estate for over 30 years, hundreds of deals. So it was a good opportunity to work with somebody new.
Okay. And this is the first time you had done a deal with this person.
That's correct.
He's experienced your experience the first time you guys are doing stuff together.
Right.
Why did he come to you when he's got, I'm just curious, hundreds of flips, and I'm assuming lots of other relationships? What stood out?
Great question. So what was interesting is that we have a department where we're constantly calling on people and trying to find new business, and we connected with him that way. His contract had just fell out, so the timing was kind of perfect, and it was kind of tight to come up to the closing. And he'd worked with national fix and flip lenders before, and the feedback he gave me was that at some point he kind of felt like a number and really wanted somebody here in the market that he could work with, meet with, have coffee with, show projects to, and that understood our market. As you know, Chris, the prices are going up rapidly, right? And so how do you talk somebody that's 4 states away into exactly what's happening in our Denver market?
Yeah, they don't, they go read a Zillow article, right, which is not the greatest.
Right.
So most of his experience with lending was just the national lenders.
Exactly right.
Oh, okay.
Exactly right. So what's unique with us is that we kind of have the national products, but then with a local presence, right?
Yeah.
So we can grab coffee or go to your project or walk it or help you get through something or provide a vendor referral if necessary.
Okay, so the 6-day close is very quick, and so a double close, so close in the first one, presumably in the morning, then closes again in the afternoon.
Right. Well, that was going to be his plan if he was to wholesale it. So he was actually under contract directly, and he was going to wholesale it, but that buyer fell through, so now he wanted to close on it on his own.
Oh, so you didn't have to do double close.
No, so he was the original
contract.
Okay. Yep.
So able to do that. Now, the BPO valuation, 6 days is very quick for that. Was there any changes like in title work or other stuff that can jam up a quicker close like that?
No, Colorado is actually unique in how quick our title companies work. And we may not realize that until you start to do business in other states, how great it is here. And with relatively new properties, less than probably in our market, 60 years old, like title comes out pretty quick. Lot lines are relatively even, master plan communities. So no big deal with title.
Okay. So you're able to get the ball to the finish line. Now, of course, he likes you guys because you guys are local, but also rates and terms and loan products matter a lot too. So what was a high level like numbers or I should say high level on the financing that you're able to put on this property?
Yeah, so we would go to 90% loan to cost, and in some cases we can go as high as 95% loan to cost for the right borrower and when the deal is strong enough. In this case, we actually hit our loan to value limit before our loan to cost limit. So we would go 90 to 95% loan to cost for most experienced borrowers, up to 75% loan to value. So we actually hit the 75% before we hit our loan to cost. So this one we were like 87% loan to cost. So he had about 13% into the deal between purchase and construction. So the numbers on the deal, bought it for $535, $20,000 in repairs. So that's $555 total. He had 13% down, which I think shook out to maybe around $60,000. Our general pricing is between 1 and 2 points. And I would say probably 8 to high 9s, depending on a lot of different things, loan to cost, credit score, experience. And so this guy had a ton of experience. So he had pretty favorable financing on this deal. So he had a little bit of money into it.
So let me pause you because you threw a lot of numbers on there. I want to make sure. No, you're good. I just want to make sure because like I've realized your mind is very quick at the numbers and the math here, which is good for a lender. But for people like me, I got to slow down a little bit. So purchase price of $535. And you said 20,000 repairs, so this is mostly cosmetic?
Yeah, pretty light. I mean, and 20 might even be long. We're talking paint, carpet, countertops, maybe some appliances, clean up the outside just a little bit. 20 is probably long, but he wanted to make sure that he had enough to get the project done and kind of meet the requirements of the end buyer.
And what was his expectations? Actually, I mean, asked before, has this closed yet on the resale side?
Yeah. Oh, okay. No. We closed the purchase or the flip financing a couple weeks ago.
Okay, cool. What's the timeline from when he took possession of a few weeks ago to turning around and putting on the market?
Yeah, on this one, I'm guessing it'll probably be maybe 45 days, short post-doc, opportunity for the people to get out and then, lining up your crews, getting everything done and getting it. In this market, you want to make sure that you're 100% complete, ready to go on the market for absolute top dollar.
Okay. Now, when it comes to you said 45-day turnaround time, that knocks out Fannie loans because those are FHA loans. Those are a 90-day hold period, right?
I think on a certain dollar increase, and they not on Fannie. I thought that was on FHA that had the 90-day.
I'm sorry, yeah, FHA. Yeah. So a lot of times, are you seeing? Totally random question here, but are you seeing? Because I know in the past I've talked to a lot of flippers where they want to hold that 90-day mark, but with how crazy the market's been, are flippers less worried about that 90-day period because a lot of people are not using FHA loans?
You're exactly right. There was a time where you might wait heavier rehabs just took longer, and you might wait till that 90-day. The way the market is today, with like 8 days on market and really well qualified borrowers at a 650 resale value, nobody's going to be concerned about somebody's ability to purchase this.
Okay. So 20,000 in, and that's rounding up, about 45-day close time, and then reselling at 650. And then before we break that down, you were talking about kind of like the terms at Renovo. You said it was like 1 to 3 points typically.
1 to 2.
1 to 2.
Yep.
Okay. And then your interest rates are pretty.
Yeah, maybe low 8s to maybe high 9s.
Okay, so that's very competitive on the hard money range. So that's great. So obviously, like you're local, good rates and terms. So you check off those boxes, and you guys closed. Now coming back to the resale at 650. He's looking at a spread of what, close to like 80,000 on that?
Yeah. So there's a $95,000 gross spread between 650 and 555. And so, you've got some costs here, right? You've got some costs of finance. You've got your closing costs on the back end. But also this is where I think that sometimes we might miss too. And I say we by maybe people like you and I that are in the business for a little while. A lot of times you look at things and, that's too high LTV or whatever. Because I think all in he's like 86 or 87% loan to cost. but this is a spot where average days on market is like less than 10. It's one of those where it goes on the market on Friday and it's under contract pretty quickly in a pretty desirable area with a really light rehab. So let's say if we shook these numbers out at 650, he's an agent, but even if he wasn't, let's call it what do you say? Maybe a 6% cost to sell. So there's $40,000 off the top. So now you're at 610, minus maybe some holding costs, title, and that type of stuff. Let's call it 600, sake of conversation. So 600 minus 555, $45,000 net, which, may not seem like a ton of money, but for a really simple deal and for a guy who does good volume, how many of those a year do you have to do to make an okay living? Not a ton, right?
Yeah, I mean, especially at that, I mean, that's a good spread. And this seems like, I would say, a lower risk one based on, you said, location, age of the property. And plus, I mean, this is just a really good price point around Denver Metro.
Right.
Like, I mean, $650,000 is still a lot, relative to the nation, but for the Denver Metro, that's not expensive.
Right.
And that's a lot of first-time home buyers and younger people wanting to buy a property in that range. So there's huge demand there.
Yeah, 4-bedroom, 2.5 bath, 2-car garage, 2,700-ish square feet. It's kind of right down the plate for somebody who might be a move up or a first-time buyer.
Okay. So what is this? I know we recorded a podcast on doing a development deal with one of your clients in the Springs on the duplexes and townhomes, and you had a really cool way for people to get their draws.
Sure.
I'm assuming in fix and flips, most people going through a draw process. Are they able to do that streamline iPhone app?
Yeah, same
draw?
Scenario. So just to recap a bit, we have what we call a virtual draw. So you download
virtual
an app.
draw.
Yeah.
Okay.
And you're going to schedule time with somebody on a Calendly, and you show up to your site, and it's kind of like a FaceTime in some ways. So you're going around, you're showing flip projects a little different than new construction, right? Because you can sometimes see whether something's done or not a little easier, right? Framing versus putting in cabinets as an example. But you're going to go through the property. You're going to show them using your phone what's completed, and they're going to use that on their end and mark off what's done. So let's say all of the cabinets are there, check that off. Let's say half of the windows are there. You just kind of show them where half are installed. Then you could take half of the money that was executed for that, or tile, or whatever it might be. We really try to use a common sense approach way to keep the money flowing to the borrower so they can keep their guys paid, less of their money into the deal after the close, and continue to move the project forward.
Now, do you have set draw periods for here, or is this just like as the client needs it?
Yeah, as
they can schedule with you.
Take it weekly. They could take it bi-weekly, or they could take it once a month, or they could I've seen some that do all of the work and get all the way to the end and then just take the draw at the end. Which everybody has a different need for capital. Because you're only paying interest on the money that's advanced. Some people say, well, gosh, I'm going to save X amount of rate on this money since I have it on hand after I've already completed the work. Now I'll collect my draw. Or, I've done, let's say it was a bigger rehab. Let's say it was 100 and you did all of that, but your next opportunity popped up. Now I can take that draw, know that I'll have it in just a couple of days, and use that money potentially to do the next deal.
And I mean, that's, I guess, one of the things people can do with you, since you have a quick virtual inspection draw process. And you said a lot of times, like the next day or 2 days, you guys are wiring the money out.
Yeah. So I hear from people frequently that say, oh, I don't do loans with draws because I don't want to go through the process. So that's really interesting. So you borrow money from a lender and you pay points and potentially fees on money that you don't ever use. Yeah, that's right. But it's there if I ever need it. Well, why do you do that? Because the draw process, it takes too long. It's too slow. It takes a lot of paperwork. I don't have time for that. Whoa, well, let me show you how maybe it's not even you. I've had people where their contractor actually does a draw. Hey, you want to do the draw? Schedule a time, download this app. And then their contractor could actually go through and show what's done, or their project manager, or somebody on their staff, or their real estate agent, or you know what, if nobody's available, I can do it, right? And then we show that what's done, and then there's a DocuSign that's created that the borrower actually signs, so they know what's going on, they know what they're receiving their money for, so they could potentially even do a draw while they were out of town or on the road or something like that, get the money in, and then get their person paid. So it doesn't have to be the borrower, which also adds some flexibility to the person who has a lot going on, or a day job for that matter, and doesn't have the flexibility to get a draw done. Yeah,
because I imagine, most flipper, their goal is to run the project, and then after looking for next deal, they have to keep the pipeline full.
Right. Not spending time
doing paperwork.
Exactly. Right.
And let me go meet you at 2:30 here, and then wait 2 weeks for the money.
Yep.
Yeah, your virtual draw, man, that is really, really cool, because I didn't know about that until today. All right, so getting back to the numbers here, we're expecting about 45 days. It'll be on the market, and then he should walk away with around a $45,000-$50,000 profit. which just, not a huge profit margin. Like I said, it's simple, it's safe. He does volume. Seems like a good payday to me.
Yeah, for sure. And on an asset that's not very old, so not very many surprises when you're getting into the rehab, and your end buyer is getting a product that's, updated, but not a super old house in a really desirable neighborhood. This is a deal I'm doing all day long.
Yeah. So I'm curious, because we are recording this in early May, and we all know what's happened. Interest rates have gone up 2 points in the last 2 or 3 months here. From like a fix and flipper standpoint, who's buying this, or from your perspective where you're lending and figure out LTV on a few months in the future, is the rising interest rates, is that coming into any play into how you guys are forecasting what the final valuation will be?
Not yet. I spend a lot of time reading about this, and every time we're in a cycle, it's something different. History shows us that you could get a couple points in rate before it gets too crazy. A 5 or 5.5% rate actually isn't that crazy, even going back to 2000, maybe 17, 18, maybe parts of 19, and at this price point. So what we have to keep in mind is the last time the rates ran up like this, there was a lot more inventory. So when I just look at inventory, because we're funding stuff just like this, $650 or $3.5 million new construction project, and you have to ask yourself, well, like, what is the risk on a $3.5 million deal that might not be done a year from now? As we look at the inventory, I'm just not seeing anything that would indicate, could prices slow a little bit? Sure, that's possible, but that also happens somewhat seasonal in our market. So we just have to make the best decision we can with the information we have today. But we certainly can't say, hey, rates are up 2 points, there's no way it'll be worth that in X number of months, when we've only got, although inventory is up here locally, it's still significantly lower than it has been historically. So I think as long as inventory continues to drive our growth, we don't make decisions like that. And I think probably another 45 or 60 days from now, people will accept that these just are what the new rates are.
Yeah, it's new norm.
Exactly.
Okay. That's very interesting, because I imagine it's not just you, but I know Renovo, they're a big institution.
Sure.
They've got probably a room full of analysts,
Sure.
and they're probably way smarter than you and I are. And they're in the same data, and there's no concern there.
Yeah. I'll just give you an example just real quick. On a new construction deal I was working on, $3.5 million valuation. And this was right when rates started to run up. So I asked the appraiser, I said, hey, what do you think? What are you seeing? Rates are going up. How rate sensitive is this purchase price? And he says, well, I'll just point out that 3 of the 5 comps were cash purchases. So probably not very rate sensitive at all. And I thought, wow, that's really interesting, because somebody who's buying a $3.5 million house for cash, they would obviously, I think you and I would be able to get a higher rate of return than the interest rates today on that type of money, but they're comfortable enough buying it in cash that if they had to finance half of it or do cash out or something like that, if things got weird, they certainly have the ability to do that.
Yeah.
And so that the rates are really going to squeeze the lower end buyers, and it kind of sucks for them, right? Because first time buyer, maybe not trade up as much because you probably have some equity, but you think about first time buyer and a 5.5% rate, and you just squeeze enough money to put down, it's our average price here now in the metro, 700,000 or whatever. Like that's who it's really going to squeeze.
Yeah. All right. So going back to this deal, anything else that you want to highlight in this deal or talk numbers as we close this up?
No, I think that we've covered it pretty in depth. I think that this is kind of a typical deal for what we're seeing today, with sometimes a lighter rehab to get to just quicker back on the market.
Yeah.
Good margin and volume. And I think that this kind of captures all of that.
Perfect. And as always, Travis, we're going to put a link in the show notes to that first podcast we did to get a great overview of you, Renovo Financial, your lending products. I know you always like to do a short call with any potential interested borrowers and just kind of run through, hey, what's your background? What you're up to? We'll put that link in the show notes as well. Beyond people just like scheduling a call with you, do they need to do anything else in prep work before they talk with you?
Yeah, just good to know what you've accomplished or where you're hoping to go. Scheduling the time on the calendar is probably the easiest way, because then we both know we're available. We talk for 15 minutes and say, hey, does it make sense to continue this conversation, get together, walk a project, grab a coffee or something? Other than that, always available at travis@renovofinancial.com, and feel free to call me anytime, 720-427-7117.
Travis, this is great. I appreciate you coming out, walking through the numbers, and we'll see you next podcast.
Perfect. Thanks, Chris.